Can you help us understand this trend for something called dark capital, which I'm reading a lot about at the moment?
Yes, I mean, it's a term that we've coined here. I mean, I've been looking at financial markets for over 25 years. And my sense is that there's been a structural change certainly over the last 5 years, probably over the last decade. And dark capital is, I guess, summarizing this idea that the gap between actually the available capital and that capital which issuers can access is growing wider and wider and wider. Now, there's a whole range of reasons for it. The fact that regulators have pushed rules that make passive investing much more attractive. So, your pension fund is going into low-cost funds. Those are naturally going into the sort of larger cap stocks because that's where the indexation is. The dislocation as a result of MiFID II and the change in the sort of sell-side environment, growing pools of capital outside of institutional sources. So, the growth of family offices, the growth of retail. And access to that is no longer through your traditional channels of going down the sell side. My key thing about dark capital is that there's a very different landscape out there, and you need a different strategy of approaching that capital.
Yeah.
That capital's there and it's available. You just need to find a different way of accessing it. And I think it's really, really important that you do, because structurally there's a genuine problem right now, which is that we're seeing relatively low levels of liquidity and actually quite a thin market. So you see this volatility. If you want to be the company which weathers a storm and your share price isn't affected as badly, you need to broaden out and diversify your shareholder base using these different sources of capital. And I think that you'll fare better than your peer group if you go about doing that.